Expectations for Fed rate hikes seem to be the biggest factor weighing on gold and silver, but our next guest says this is just one short-term driver. Instead, he turns his attention to other key drivers. We'll be talking with CME Group's Erik Norland today, who joins us back in studio. Erik, good to have you back on the show.
Thank you for having me.
So the Fed rate hike, which many would say really is the elephant in the room for gold and silver, you say, well, wait a second, this might just be one short-term driver here.
That's right. I think it is the short-term driver. The gold price has shown a very, very strong correlation to the daily changes in Fed funds futures over the course of the past year and a half or so. And generally speaking, as rates rise, that causes, or rate expectations, I should say, increase, that causes the price of gold to come back down. Silver is also sensitive to it, but not to the same extent as gold. And the other two precious metals, platinum and palladium, don't show much sensitivity at all. But it is true, though, that while that tends to be the main day-to-day driver, there are other forces like mining supply, for example, that also exert a strong influence upon price.
Well, I know you just did a research report on mine supply. So what's happening on that front here? Are we seeing a shortage or not? What are we seeing?
Well, mining supply have been growing very, very strongly for many years. It really hit bottom around 2008, 2009, and then began to increase very, very substantially. Of course, spurred by the much higher price of gold that we saw. But as gold came down from $1,900 an ounce to as low as $1,050 last December, that put a lot of downward pressure on mining companies' profits, and a lot of them began to lose money. So what we noticed in the first 2 quarters of the year is the mining supply stopped growing in the first quarter and actually began to contract a little bit in the second quarter. I think the question now is, will mining supply recover now that the price of gold, I should say, had rebounded for a while above $1,300 an ounce? Now we know it's actually a little below that level.
So what impact could it have on the price of gold, for example?
Well, generally speaking, the more mining supply increases, the worse it is for the price of gold. You can sort of view mining supply as the growth in the money supply of gold. And so if you look at the outstanding stock of gold, each year's additional mining supply, which now comes to almost 94 million ounces of gold per year, that adds roughly 1.5% to the outstanding refined stock of gold in the world. And if that number begins to grow, it tends to put downward pressure on gold prices.
So when can we have a better understanding of the actual mine supply? In what time frame?
Well, they generally release quarterly numbers, and the quarterly numbers are unfortunately released with a fairly substantial lag, and those are subject to revision. So it may be a while before we get a really strong sense. I would expect that maybe by early December we should have sort of the preliminary numbers in for the third quarter. And that'll be very interesting to see if it started to rebound as a result of the rise in gold prices over $1,300 an ounce, where they spent much of the year up until the last few weeks.
So you can't wait for those results, Erik, right?
Oh, it's going to be exciting.
But I know you've also been doing a lot of research on the gold-silver ratio. I know you're almost an expert on this topic here. It's at historical levels right now. How important is the gold-silver ratio?
Well, I view them both as sort of currencies. I mean, they were historical currencies. You can still view them as currencies today. But the relationship between them is not stable. 30 years ago, 1 ounce of gold bought maybe 25 ounces of silver, and now it's buying close to 68 ounces of silver. So it's moved a long, long way in gold's favor. We're a little bit off the highest levels. For a while, it had gotten close to 80. So we've come back down to 68 now. And I think that there are arguments you could make either way, but I think that if interest rates begin to rise, that would be not favorable to gold. It would be more favorable to silver. So that gold-silver ratio would probably begin to decline.
Interesting. So if we do see a Fed rate hike, not good for gold, but could be good for silver.
That's right. I think it depends on the timing. Right now, the market has fully priced that rate hike for some time next year. But if the Fed moves earlier than that, like say in December, that would probably be more negative for gold than it would be for silver.
All right, Erik Norland, thanks so much for stopping by.
Thank you.
And thanks for watching today's edition of Kitco's Gold Report. We'll see you tomorrow.